I know John wants to talk claims with Lisa and all the other stock mumbo jumbo. I want to talk to you about the virus and how all of a sudden I'm seeing the headlines of it moving into the great Middle West of this nation. What have you observed out of the Leuthold territory on the new advent of cases and deaths in the Midwest?
Well, we've actually been pretty good here, Tom. We had a spike earlier too, and kind of seemed to get it under control. And although cases have come up a little bit here, I think a lot of that's testing, and we haven't had a big increase in deaths. But there's quite a concern. We're pretty good at wearing our mask here and trying to do all we can to keep that at bay. We're a little worried about us restarting school and what impact that may have. But, you know, outside of that, I think we're doing pretty well so far.
You know, when a man is in cash and has been for the last decade, maybe 2 or 3, he starts calling the stock market and talk about it stock mumbo jumbo, Jim.
Got that right.
Jim, you haven't done what Tom has done for the last several decades. You've been fully allocated and bullish.
Mumbo jumbo is an Iowa State term, I'm pretty sure. That's,
well, let's talk about this equity market. How does this stock market respond if the data goes in the wrong direction at 8:30 Eastern in 10 minutes and again tomorrow morning?
I think badly, John. If it's truly an outlier to the negative side, I think we get, you know, we get a period of I don't know, full-fledged correction, but certainly a pullback. But I think it's got to be, you know, a true outlier, not just somewhat disappointing, but, you know, widely disappointing, because there's so much error in this data, and no one, you know, when we're talking about millions every month or every week, you've got to have a pretty big error to make that stand out. You know, even like the ADP report, which came in way below, and then they revised up the previous month's a WAP. So I think a big movement either side of forecast could have big impact in the short run. But I think whatever way it goes, you know, there's still, to me, a fair amount of positive momentum going on here with other reports, whether you look at what's going on with manufacturing and service sector ISMs, for example. So although it's going to have a lot of short-term impact potentially in the stock market, I think it could burn itself out against what other data. And with national cases of the virus coming down and deaths peaking out, you could see some of the on-the-ground data, economic data, start to improve again here as we move into August as well.
Let's talk about where some of this money's parked as well, Jim. You've mentioned the $5 trillion of money in money market funds. We caught up with PIMCO's Jerome Schneider. He's talking about the same thing. What will it take to tease some of that money out of something that's giving you nothing right now?
Yeah, I've just been amazed by the wall of worry that we have and the defensive behaviors. I mean, we've got a stock market that's up 50% from its lows in a very short period of time, and you still got people holding almost $5 trillion of money market funds with zero yields. Every month there's a chronic inflow into bonds at 50 basis points on the 10-year and an outflow from stocks. We've got the American Association of Independent Investors, you know, bulls less bears at one of its lowest levels in history. It's pretty amazing, and it is hard to see what's going to change that. But I think one thing that would certainly do that or help it would be a new high in the overall S&P 500.
Wait, so new highs beget new highs, basically. Well,
I think that could change the headlines,
Well, certainly, Jim, when we talk about the balance of risks, when we talk to central bankers, they say the balance of risks are to the downside. And for the past few months, when we talk to equity investors, the balance of risk has been to the upside, this idea that you could get better than expected data, or if it underperforms, central bankers and fiscal policymakers will come out with a bazooka and blow it all away in order to make way for new highs. Is that equation shifting now based on what you said about how a really big negative surprise would be negative, full stop?
Well, I think it could be if it's bad enough, Lisa, you know, but I think it's short term, because I think we've started the new economic recovery, and what probably the biggest thing that gives me optimism is the massive divot that was created by this pandemic in terms of the economy. We had a record-setting collapse in GDP, a record-setting collapse in inventory drawdowns, a record rise in the personal savings rate, a huge drop in the earnings, a record rise in unemployment, and that all is terrible. But what that tells me is that we have so much room in the next few years to improve the economy again. Imagine the operating leverage for a company if we move that unemployment rate from double digits back to 6% unemployment again. That's incredible earnings abilities. And now we're going to do that with virtually no inventories on the books and whittled down to the bare bones. So I guess this is how recoveries start. It's not surprising to me that this bull market so far is moving very closely with the '82 bull market and the 2009 bull market, the other two recessions that created the biggest double-digit unemployment rates in post-war history. In other words, the biggest divots. And those were followed by really nice and prolonged bull markets. I think this one is going to be another one of those.